This is the game that they never taught us in school. The majority of people work hard to earn a salary, while the wealthy and the people that become wealthy work hard to buy assets that pay them 24/7. And here's the difference. If you stop working here, you stop making money. But if you stop working here, you keep getting paid. And if you do it correctly, this income stream that you're getting from here can replace this income stream. That way you don't have to rely on your 9 to 5. But there is a catch. Building this is not easy. It is going to cost you money and it's going to take sacrifice, but it is possible. And in this video, I'm going to show you the 3 passive income producing assets that the financially savvy, the rich, and the wealthy love buying. That way you can start doing it too. Number 1 is physical real estate. This one is the hardest. It's going to cost you the most money. It's going to take the most time, but it is my personal favorite. Here we have a $180,000 house. Yes, these houses are on the market like you see here with this 3-bedroom, 2-bath house in a nice suburb of Michigan. The way real estate investing works for cash flow is you're going to go out and buy this house not to live in yourself, but instead you're going to rent it out to this nice family right here. So they're going to move into this house and now they're going to pay you rent in exchange for living in this house. And let's assume, because this is a nice house, that they're going to pay you $1,900 a month in rent. Yes, this is possible. Just go back to the Zillow listing and you'll see that the $180,000 house has a Z estimate of $1,957 a month in rent. That adds up to $22,800 a year in revenue, which is a lot of money, but it's not all yours, because now that you own this property, you also have to pay for the expenses. You have to pay for the property taxes, you have to pay for the insurance, you have to pay for the maintenance, you have to pay for the management fees, because you're an investor. You don't want to be managing the property and cleaning the toilets and doing all of that. And then you have to pay for the vacancy, because there's also going to be times where the tenants move out and you're not generating any rental income. Now, if we do some rough math, if 50% of your revenue goes to expenses, that means you will be left with around $11,400 at the end of the year in profit. Now you might say, well, that all sounds good, Jaspreet, but I don't have $200,000 to go out and buy this property. Well, you don't have to go out and buy this property all cash, because there are alternative ways for you to get started in real estate with less work. Take a look. When you buy a house to live in yourself, it is called a primary residence. And as a licensed attorney who is not your attorney, I can tell you that a primary residence has a little bit of a unique definition. A primary residence could be a condo, it could be a townhouse, it could be a single family house, it could be a duplex, it could be a triplex, or your primary residence could be a 4-unit building, which means you can go to the bank to get a mortgage, not just for a condo or a townhouse or a single family house, but you can also get a mortgage to live in for yourself for a 2-unit property, a 3-unit building, or a 4-unit building. And now you can live in this unit and rent out the other units to your neighbors, who will now pay for your mortgage for you. Take a look. Let's assume that you can buy this 4-unit building for $600,000. Yes, these types of units still exist. Take a look at this 4-unit building in a nice suburb of Michigan for less than $400,000 for sale, and these units are already rented out. But this is where things get interesting, because now you can get a mortgage to go out and buy this $600,000 building. It's a 4-unit building. You can live in this unit right here, and now you can rent out the other 3 units. And let's assume that you can rent out the other 3 units for $1,300 a piece for 1, 2, and 3 units. Now you have a mortgage, but your costs are going to be subsidized through the help of your nice neighbors. That means your neighbors are going to pay you $46,800 a month, but again, you have property expenses. You have to pay for your property taxes, you have to pay for your insurance, you have to pay for your maintenance, you have to pay for the management fee, although yes, you could manage these units, but you still want to factor in a cost for that management fee, and then you have to factor in the vacancy cost, because people will move out at some point. So let's assume again that about half of your revenue is going to be expenses. That means you're going to be left with around $23,400 a year after paying for your expenses, but you still got your mortgage. And if you go out and you put 20% down, you put $120,000 down on this property, you finance the other $480,000 at 6.5% for 30 years, well, that means your monthly mortgage payment is going to be $3,000 a month or $36,000 a year, which means you take this money, this $23,000, and you apply it to the $36,000, and that means your monthly payment out of pocket to live in this property is going to be around $1,000 a month, which means your mortgage payment to live in the property is less than your neighbor's rent. And this is where things get interesting, because when you buy this primary residence, you have to live there. But the question is, how long? Well, what most mortgage contexts will tell you is that you have to live in this property or have the intention to live in this property for at least a year and a day. So you live in this property for a year and a day, and now you move out, and then you rent this unit out for $1,300, just like all the other units. Now you own this property, you have your primary mortgage on it because now you have a lower mortgage rate because mortgages for your primary house is cheaper than an investment loan mortgage. And now you're making that additional $1,300 a month, which means you're profiting $300 a month on this property. And I can go buy another 4-unit property and do it again and again and again as a way to start building your real estate investment portfolio. This is a much more accessible way that people that are flexible can go out and start building the real estate investment portfolio without going and buying other properties. You can use your primary residence as a tool to start building your portfolio. Not to mention that if you buy this property in a good area, in a couple of years, you might be charging $1,400 a month for each unit, maybe even $1,500 a month for each unit, which means you get to make more money because of the investment that you purchased. The second asset that wealthy people want to own for this type of passive cash flow are stocks, because some companies in the stock market are making big profits. And when you make a big profit, there are 3 things that you can do with this money. You can save this money for an emergency, you can take this money and reinvest it back into your company, or you can give this money away to your shareholders. So for example, McDonald's. McDonald's is a publicly traded company, which means anybody, you, me, or really anybody can go buy 1 share of the McDonald's company on the stock market. When you buy 1 share of the McDonald's stock, you become one of the owners of the McDonald's company. This is where things get interesting. McDonald's is making billions of dollars of profits, and they will save some of that money, and maybe they'll reinvest some of that money to open new stores and maybe make better hamburgers. But then the third thing that McDonald's does is they just give billions of dollars away to their shareholders in the form of something called a dividend. A dividend is a cash payment that a company gives you for doing nothing except owning a piece of that stock. Now, the amount of money you're going to make in a dividend is going to depend on how many shares you own. The more shares you own, the more dividends you're going to get, but it's cash that's deposited into your account generally every 3 months for doing nothing except owning the right stock. You don't have to go and flip burgers, you don't have to go and work in the corporate headquarters, you don't have to do anything. If you own the stock, you get money deposited into your account, and this can be a steady way for you to invest for this cash flow if you do it right. So let me break down the way that you can generate this type of cash flow in stocks into 3 different categories. You can invest into individual stocks, individual companies. You can invest into funds that are specializing in paying out high dividends, and you can invest into international companies that are focused on paying high dividends. I'm going to give you specific examples in each one of these. And I also want to remind you that for those of you that are investors or want to become investors, I just put together a brand new investing masterclass where I walk you through how you can start investing or find better investment opportunities before the crowd. I'll show you the exact system that my firm and I use to find investment opportunities before they hit the headlines. There's a ton of value in this masterclass. So if you want to watch this masterclass for free, all you have to do is register, and I have the link for you to join down in the description below. And as a bonus, you'll also get Market Briefs, my newsletter for investors, as a complimentary bonus just for joining and signing up for that masterclass. Let's start by talking about individual companies. This is what most people think about when they hear stock market investing. And here's an article on Yahoo Finance talking about the highest paying dividend stocks in the Dow Jones. 3 of the stocks that this article talked about are Verizon, Chevron, and Merck & Company. So let's break this down. But of course, I gotta remind you, investing is risky. You are never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. Okay, I'm not telling you what to invest in, nor can I tell you what to invest in because I'm just a random guy on YouTube. I'm not a financial advisor. Let's start with Verizon. At the time when we're recording this video, Verizon is paying out a dividend of around 6.2% a year. Chevron is paying out a dividend of around 4.3% a year, and Merck & Company is paying out a dividend of around 3.8% a year. What that means is if you were to invest $100 into Verizon, you're going to get paid $6.20 of cash flow for doing nothing except owning the stock over the course of a year. Now you might say, well, Jaspreet, that doesn't sound like a whole lot. Well, the idea with dividend investing is to keep investing your money consistently. That way you can work to acquire more shares of this thing that keeps paying you dividends. And then as you get that dividend, you can keep reinvesting that dividend. That way you can accumulate a larger and larger share. That way, as you own more shares, each share is going to be depositing money into your bank account. And if you do this year after year after year, well, slowly you'll start to build up a solid stream of income, which you can use to buy more shares of that company that's paying you dividends, or you can also use it to start funding your lifestyle, paying for your car, paying for your vacations, or whatever you want to do, but it takes time. However, there's something that I want you to understand about investing into individual companies, because the mistake that a lot of people make is they say, okay, Jaspreet, if I want to invest for dividends, I should take a look at this number right here. Verizon is paying out the highest dividend, so that's got to be the best investment. But that's one of the biggest mistakes you can make, is making your investment decisions based off of this dividend number, because you want to own a good asset. You want to own a good asset here, because if that asset is good, that means number one, it should be going up in value, but also number two, if it's growing its profits, that means the amount of money it's going to be paying you in dividends is also going up. So even if you don't increase the number of shares that you own, you're still increasing your income because you have a good asset that's paying you month after month after month. So we can take a look at Verizon. It's paying out a very strong 6.2% dividend, but if you look at the Verizon stock over the last 5 years, the Verizon stock is down 25% over the last 5 years. And this is where investing in individual companies comes with the highest risk for the highest potential return. Because now if you invest in a good company that goes really good, well, now not only will the value of your investment go up, your dividends will go up, but you also have the opposite potential as well. The company investing could also go bankrupt. Now, not only do you lose your income, but you also lost all the money that you put in. So if you're going to be investing here, understand you have the highest potential return, but you're also taking on the most risk, which is okay for some people, but for a lot of people, it's not worth it because you don't want to keep up with the earnings calls. You don't want to keep up with the financial statements. No big deal. This is where we can take a look at number 2, ETFs. An ETF is an exchange traded fund. This is a basket of stocks. So now you're not going to invest into one company, you're going to invest into a group of companies. This way you have more protection, less risk, and less potential upside, but still consistent income. So again, 3 very different examples here. Number 1 is NOBL Noble, which at the time of recording this video is paying out around a 2% annual dividend. And Noble is investing in companies that are a part of the S&P 500, meaning this is only investing in companies that are in the 500 largest companies in the stock market. But not just that, they also have to be paying out a dividend. And not just that, they also have to be a dividend aristocrat, meaning not only have they paid out a dividend, but they must have had to increase their dividend every year for at least the last 25 years. So this is focused on investing in those specific large companies that have been working to increase these dividends consistently. That way, hopefully, you can continue to see dividend growth. That's Noble. Another example is VYM. As a disclaimer, I'm personally invested in VYM. This is a fund created by Vanguard, and this is focused on investing in a broad basket of high dividend paying stocks in the United States. So not as specific as this, but it's investing in a broad basket of high dividend paying stocks in the United States. And if one of those companies were to go bankrupt, well, this company would kick them out and replace it with another company. At the time of recording this video, it was paying out a 2.6% annual dividend. And then we have MORT, M-O-R-T. This is a REIT, Real Estate Investment Trust. At the time of recording this video, it is paying out a 12% dividend, which can sound very attractive. But remember what I talked about here. High dividend yield doesn't necessarily mean good investment. This is focused on investing in real estate investment trusts, more specifically companies that are involved in the dealing of mortgages, which is very risky. So you'll have much more volatility here, more risk for more potential return. And you have to know where in your life cycle of your investment journey that you are. Do you need more risk or do you want more stability? Because depending on what you need, you should change how you invest your money. But this brings us to category number 3, international investments. Everything that we talked about so far, the stocks and the ETFs, are focused on the United States market, but there are certain countries around the world that are smaller, that are working to grow, while the companies inside of those countries are also working to grow. So you can potentially see a double benefit where the company is growing and the country is growing, so you could see a growth in dividends. But there's also a risk because these countries might not be as stable as the United States. Their currency might not be as stable as the United States dollar. Their military, their government might not be as stable as the United States is. So you have more risk for more potential return, but you can also get some higher dividends. Take a look. VYMI, this is another ETF created by Vanguard. It's essentially the same thing as this, but this is focused on international stocks, not in the United States, that are focused on companies that have higher than average dividend yields. And a lot of these companies are in emerging markets, meaning the smaller countries that are working to grow. So you could see the potential for the country to grow and the company to grow, but more risk because it's not the United States. So you could also see those same countries and companies fall, which could hurt the dividends. But at the time of recording this video, it's paying out a little bit over 4% a year in dividends. Another one is LVHI. This fund is focused on investing in more of the developed countries around the world, not the emerging markets, just the developed countries. So it's working to provide a little bit more of stable income outside of the United States. But again, risky because it's not the United States, but a little bit less risky than just emerging markets because it's focused on the developed markets, trying to produce that stable income outside of the United States. And at the time of recording this video, is paying out around 3.6% a year. So if you wanted to get cash flow, you can invest in real estate. It takes the most work, the most time, the most money. Or you can invest in stocks, which you can do through specific companies. You can do it through ETFs. You can do it through international investments. Again, this is just a small taste of some of the opportunities out there. There are tons of opportunities out there, and so you can just do a little bit of digging to see what you like. The key to winning here, by the way, I didn't mention yet, is to consistently keep investing your money. I call it ABB, always be buying. To set up a system where every week, every 2 weeks, or every month, you're just gonna keep buying this cash flow. You're gonna keep buying shares of this thing that you want to own. That way you can accumulate more shares consistently year after year after year. After you generate that dividend is also gonna buy you more shares. That way, 5, 10, 15 years from now, you can have a lot of shares of this dividend producing thing, and that can start to produce a solid stream of income that you can use to buy more dividend producing shares that's going to pay you more money, or you can use it to pay for your car, your vacation, or whatever you want to do. And the third way that you can generate some sort of passive cash from your investments is by lending your money, more specifically lending your money to the United States government. This is called a treasury, and let me show you very briefly how the United States government works. So the United States government goes out and they collect tax dollars from Americans. The problem with these tax dollars is the United States government will go out and spend all of this money on things like infrastructure, healthcare, Medicare, and everything in between, but then they go out and spend even more money. And how do they fund that additional spending? They fund it through debt. Well, where do they go out and borrow this money from? One place where they borrow this money from is from regular people like you and me. So you and me can go and lend money to the United States government, and the government will pay you back plus interest. It is a loan to the United States government. This is called a treasury. And every economics textbook will tell you that a treasury is the safest form of investment. It's considered a risk-free investment. Why? Because the United States government always has the ability to pay back their debt. Why? Because if they need more money, they can just raise taxes, or this is going to get a little bit complicated, but they can also work with the central bank in the United States called the Federal Reserve Bank, who can then work to just print money and pay back your debt. So the United States government has the ability to always pay back their bills, but there's a chance that this printing of money could create inflation, which means that the value of the money that you can pay back isn't worth as much. But it can create a steady stream of income if this is something that you're interested in. This is not really a way to build wealth. It's not really a way to grow your wealth. It is a way to generate some income to hopefully at least combat inflation through a relatively low risk strategy. And low risk is very relative. Some people will say, don't ever do this, put your money in gold. Other people will say, yes, dump your money here. I mean, Warren Buffett owns billions and billions of dollars of these treasuries because he believes it's a safe place for him to park his money and generate some sort of interest. Now, how can you actually invest your money into these treasuries? Well, you can go directly to the government website. It's called Treasury Direct, and you can lend money to the United States government. And what you'll see is you're going to get a different interest rate depending on how long you invest your money for and how long your money is going to be tied up with the United States government. That can be a little bit complicated, and some people don't want to see their money tied up for that long. So the alternative would be to invest your money into a short-term ETF that's backed by treasuries. For example, there's an ETF called SGOV. This ETF, SGOV, is a short-term treasury ETF, meaning the price of this ETF doesn't really vary. You're investing into this ETF just to generate monthly interest. And because it's an ETF, it trades on the stock market, so you can buy it with any stock brokerage that you have. And now you're going to be getting paid with monthly interest payments deposited into your account. Kind of like a dividend, but but it's not a profit share. It's an interest payment that you're getting, and it's going to be monthly, not every 3 months like most dividends are. And because it is a treasury, meaning a loan to the United States government, you get some additional benefits, which is that your interest is generally not subject to any state taxes or local taxes. So if you were in a high tax state like New York or California, this could be nice because now you can generate interest and not have to worry about paying these taxes. But there are a couple risks you want to be aware of. Number one, the interest rate that you're going to get is going to depend on the interest rate set by the Federal Reserve Bank. Like at the time of recording this video, SGOV is paying out an interest rate of around 4% a year. But if the Federal Reserve Bank cuts interest rates and continues to cut interest rates, well, then interest rates could fall and the interest rate that you get from this ETF or these treasuries could also fall. The second thing is it is not FDIC insured. Like every other investment, it is not a bank. If you put your money into a high yield savings account, well, you're FDIC insured, so if your bank went bankrupt, you could at least get the FDIC insured money back, which is up to $250,000. This ETF is not FDIC insured, so if the government were to go bankrupt, you wouldn't get your money back. But it is an alternative way for you to start generating some interest with relatively low friction as a way to park your money with a relatively low risk investment that you can sell really whenever you want and then put that money somewhere else, because again, this is not going to make you wealthy, but it's a way for you to generate some interest until you find a better investment, and it's an alternative to a high yield savings account if that's something you are not potentially interested in. So if you want to generate cash flow, that way you can replace your active income, your income from your job, you need to take some extra money and invest it, and you need to keep doing this consistently, week after week after week, month after month after month, year after year after year. And if you stay aggressive with this in 10 years, I call it a decade of sacrifice, you will not be able to recognize yourself because you'll have a whole new stream of income that you can use to potentially live off of or to supplement your lifestyle or buy even more of the income producing assets. You can decide how you want to do it and how aggressive you want to be, but if you stay consistent, you keep putting the money in and you make the sacrifice, well, now you can have a whole new stream of income from your investments, and it can be relatively passive. Not completely passive because you still got to oversee the investments, but more passive because you don't have to actually work in this asset. So we talked about doing this through real estate. We talked about doing this through stocks, and in stocks we talked about doing this through individual companies, through ETFs, through international ETFs, and now we talked about how you can do this by lending your money to the United States government through treasuries or through short-term treasury ETFs. So if you enjoyed this video, the best thank you is to share this video with a friend, a family member, a colleague, or a fellow investor. And again, if you're an investor, I would love for you to watch the Investing Masterclass. There's a ton of value in there, and I think you will really enjoy it. That link for you is down in the description. According to Forbes, banks are quietly tightening up their lending standards, meaning it's getting harder for people and businesses to get a loan. We've seen this happen before. In the past, when banks would get stricter about their lending practices, it has been an indicator for an economic slowdown. And now with banks tightening the lending standards again in 2025, the question is what's coming next?